Hello traders, welcome back to the Forex Gig, where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we are going to be talking about how to trade like the banks using the Wyckoff Market Structure and supply and demand trading strategies. You will learn to identify market phases, spot key levels, and execute trade with precision. You have to stay tuned to the end to discover how the institutional techniques can enhance your trading approach. Now, the Wyckoff structure is a framework designed to decode how the institutional players, often referred to as the composed man, operate within the market. It breaks down price movement into four distinct phases: the accumulation, the markup, the distribution, and the markdown. This phase reflects the strategy employed by large investors to build position, drive prices, and ultimately overload their holdings position. The accumulation phase occurs after a prolonged downtrend. During this period, institutional players quietly accumulate assets while keeping prices contained within a range, and you will notice an increase in the volume on the upward movement and decreased volume in the downward movement during this phase, signaling a strong hand and absorbing supply from weak ones. Once the accumulation is completed, this is basically the accumulation phase. Once the accumulation is completed, the market transits into a markup phase. Here the demand exceeds supply, causing price to rise, and as you can see, it's causing price to rise to the upside, creating higher highs and higher lows, dominating the phase, often accompanied by strong volume as public interest grows. As you can see, is accompanied by higher volume. This is where institutionals begins to reveal their position to attract buyers into the trend. Now you follow this same markup phase comes the distribution. In this phase, institutionals start selling their position as elevated price while maintaining. In this case, you will see an increased volume on down days during this phase, indicating selling pressure from large players. Price action may appear choppy, but often signals weak demand and preparations for the next phase. So let's see how we can trade like a bank, and a step-by-step strategy, a way we can systematically approach the Wyckoff method and supply and demand principle. This strategy focuses on identifying the market phases, the key levels, and institutional behaviors to mark informed trading decision. We begin by analyzing the current market phase using price action and volume. Look for signs of accumulation or distribution which indicates potential trend reversals. And as we can see in this area, this is a phase of accumulation when price was moving in a sideways motion, accumulating orders. This is our phase of accumulation in the market. You will notice an increased buying volume, and as you can see, there are increased buying volume on the chart, and a decrease in volume on down days. And when we see down days, you can see there will be a decrease in volume compared to the up days volume. During accumulation, once you have identified the phase you are in, you locate key support and demand zones on that area. These areas are where price shows significant rejection in the past and often accompanied by high volume. Now to mark up our key demand areas in charts. Our key support areas, our key demand areas are these areas, and they are accompanied by volume. As you can see, these are places that the market reacted from. These are our key demand areas on the chart, and these are potential entry points for your trade. You have to pay close attention to price action around this level, as they can provide valuable insight into the market sentiment. So at these areas are areas where you can enter your buy position. You then wait for your confirmation before you enter. You look for a specific Wyckoff event such as a spring or trust, or a breakout with increasing volume, and as we can see, this is a breakout with an increasing volume. With an increasing volume. Now for the Wyckoff, I'll take it again. We wait for the Wyckoff before we enter a trade. Now for the Wyckoff, we use a different example. For the Wyckoff, before you enter the trade, after experiencing your accumulation phase, after you have experienced your accumulation phase and you have noticed price is respecting demand areas, when price is respecting the demand areas, you will see an event, a Wyckoff event such as spring or on uptrust. This is a breakout with an increasing volume. This is a breakout with an increasing volume, and this particularly dips below the support, the demand area. It dips below your demand area, as you can see the way it dips, but quickly recovers back up. When it dips, it quickly, with an increased volume, as you can see, it dips, but price quickly recovers, indicating strong buying pressure. So if you see something like this, you would know that this is also an opportunity for you to enter the trade. An uptrust is the opposite where price briefly, this happens when price briefly breaks above the resistance area. This is our resistance area. After an accumulation phase, we can see price was accumulating in this area. This was an accumulation phase. Then we can see that price briefly breaks above the resistance area before falling back down. This event often signals the end of an accumulation or a distribution phase. Then you enter when price starts respecting supply areas in the market. You can see this will be the perfect place for you to enter the trade, because price keeps respecting supply areas on its way down to the downside. So once you have identified your trading setup, you can use your limit order to enter near a key level, to enter in your position. This approach allows you to get a better entry price and improve your risk to reward. So we will determine, you can decide to enter at this area, or we can better still enter at this supply region to give us a better risk to reward and to enter quite early. As you can see, even if we decide to target the low, this will still be a good risk to reward trade. Remember, risk management is crucial when trading like the banks. Always set your stop loss orders based on the current market structure. In an uptrend, you would have to set your stop loss below the recent swing low. Below the recent swing low, you will set your stop loss below the recent swing low. While in a downtrend, you place your stop loss above the recent swing high, or above the resistance level. You can place it above the resistance level. As this trade moves in your favor, consider scaling out of position at predetermined levels to lock in profits while allowing for further gains. Remember, market condition can change rapidly, so be prepared to adapt your strategy as phases transition. If you have entered a long position during an accumulation phase and notice signs of distribution, As you notice a sign of redistribution or distribution or a consolidation phase, be ready to exit your trade and potentially reverse your position. Continuously monitor your price action, your volume indicator and your market structure to stay aligned with the institution behaviour. With all this, you can put together and make a good trading setup that you can follow with the bigger boys in the market, which are the institutional traders, the way they trade the market. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, do not forget to like, subscribe and turn on the notification bell so that you will never miss out on more trading tips and strategies. Thanks for watching and I will see you in the next video.